So now let's consider how we apply the Howey test to initial coin offerings. And we can just run down the checklist. Remember, an initial coin offering is a situation where you're going to be sending crypto to a third party based on a white paper, and you're going to get code in return, and you're going to hope that that code winds up being worth more once the system gets launched, and you're able to actually sell that crypto to other people who are going to be able to use it in the system. Well, let's go down the checklist. Is there an investment of money? You betcha, all right? The crypto that you invest counts as money. Is there commonality? Well, you've got horizontal commonality. You're pooling your money with other people that have bought the same ICO. You clearly have vertical commonality in the broad sense because you're relying on the promoter. And you also have it in the narrow sense because the promoter is keeping a piece of that crypto for itself as well. So the promoter's interests are highly correlated with your own interest. So you have investment of money in a common enterprise. Is there an expectation of profit? Of course there is. Again, it's not like the orange. You're not buying the crypto in most situations in order to be able to use the crypto. You're buying it because you're hoping to sell it to someone else at a price higher than the price at which you paid it. And also, at the time that you're buying it, the crypto doesn't even really exist yet. You have a right to the crypto, and the crypto isn't even useful. So if you're asking yourself, is this crypto something that's primarily for consumption purposes or for investment purposes? It's not even a conversation. There is no consumption purpose. There's nothing you can use it for. It's only good for investment. So we've got investment of money in a common enterprise, expectation of profits, coming primarily from the effort of others. You're a passive investor. You've put in the money, you've bought the crypto, now you've got to hope that the people who have taken your Bitcoin will actually do something productive with the Bitcoin and build a system that works so the $1,000 that you spent on that Bitcoin becomes $1 million, which is the reason why you invested. And is there an alternative regulatory regime? Doubtful. There's no federal crypto agency. It's chaos. So if you look at the existing Supreme Court precedent in this space, and what you say is the court has always deferred to other regimes when they're clearly in place, there's nothing else that's clearly in place here. So a straightforward application of the five-factor Howey test leads pretty conclusively to the conclusion that the vast majority of ICOs are securities. They can therefore be regulated by the SEC. They therefore have to be registered, or you have to find an exemption. The vast majority of these offerings do not qualify for exemptions, which means that if they're not registered, they're violating the federal securities laws. And if they wind up lying in any material way, for example, by making representations in a white paper as to how the code works, and the code doesn't work that way, you got problems, serious problems.